Good afternoon, everybody. Welcome to the Stubbs Alton Markley's Investor 360 program. We are been doing this program for several years with our partners. I see one of our partners here, Anna Evans from TriNet. Anna, would you like to say hello?
Sure. Hi, everyone. Thanks, Lynn. Thank you all for joining today. So my name is Anna Evans, and I'm with TriNet. And what we do at TriNet is really work with early stage startups to help them manage all of the HR pieces of the puzzle. So when you're looking to hire those first couple employees, you've got to figure out, well, how am I going to pay them? How am I going to provide benefits? Do I need a handbook? You know, what do I need to know that I don't know? So really, we take all of those pieces of the puzzle off your plate. We work with about 19,000 clients across the country, about 340,000 worksite employees. So we help you look and feel like a much larger company so that you can attract and retain top talent and grow in a compliant fashion. Some of the companies we work with locally are Ring, Dollar Shave Club, Netflix, Snap. So we'd love to help you guys in the same way. Thank you.
Thanks, Anna. We appreciate you being with us today. Our other partners, Silicon Valley Bank, DeMarcus Williams. I don't see DeMarcus on. We also have the Peter Mansfield with the CMO organization, and I don't see anybody here from them. Early Growth Financial Services, Mike Lilly is our partner there. And I think that covers everybody. So I'm Len Lonzi. I am the managing director of the Pre-Accelerator program, which is a program of Stubbs Alton Markley's. We are a law firm headquartered in Sherman Oaks. Our Pre-Accelerator program is here on the Promenade in Santa Monica, California. And we are a full service law firm, and we can address any of your startup needs. We have a great corporate transactional practice. We also have a litigation division. We do copyright and trademark. So we're here to serve you. If that is something that you need, you can reach out directly to me and I can help you with that. Our Investor 360 series is a way for us to have a conversation with investors, both near and far. Today, I brought a friend in that I met when I was with the Los Angeles Venture Association years ago, Vaughn Blake. Vaughn has been when I first met him, he was with a different firm than he is today. And we'll talk a little bit about that because there's a connection there. And we're going to learn about Blueberry Capital and what they focus on. And we'll learn a little bit about Vaughn today. Vaughn, I didn't give you much of an introduction. I'll let you do some of that introduction yourself. Folks, I'm going to keep you all on mute, or if you can mute yourselves during the conversation. We will have a robust question and answer period afterwards, and we will end at about 1:15 this afternoon. So that puts you into a timeline. If you don't know how to use Zoom, the best way to do this is under speaker view, but I'm also going to make spotlight Vaughn, so he is here with everybody, and I'll spotlight myself, and we will get started. So that being said, welcome Vaughn. It's good to have you here. And why don't you tell us a little bit about yourself and your journey to becoming a venture capital partner?
Yes, thanks, Len. Really appreciate the invite. It's great to be here and have a conversation with everyone. We can. I'll give my background before diving into Blueberry. So I started out really. I launched my for an initial startup myself that was an abject failure. That was basically it was a very early influencer platform, basically before Instagram even hit its hockey stick. So there were a series of restrictions on its success. One was customer acquisition. Two was actually transacting within the app. And three was just a CEO and founder who didn't quite know what he was doing. So that crashed and burned, but it really just opened my eyes up to understanding that financial technology itself was going to be a big part of the mobile revolution. That and financial inclusion were two of the primary motivators for me to stick around in the startup community. My first company or successful sort of foray was a company called CoinMarket that was here in Los Angeles. It's a really early digital currency exchange. So, very early, our sort of differentiation at the time was we were heavy on the compliance for Bitcoin and Litecoin trading. Traded a variety of different instruments back then. This is, far before even the last crypto bubble. I think this is 2013 era, so a long time ago. But LA had a thriving early Bitcoin scene that I think is often overlooked or not quite as remembered as some of the other sort of famous Bitcoin or early Bitcoin hotspots. That company was able to have a relatively successful exit, exited to a New York-based exchange. After that happened, I moved over to a company that was actually incubated right here at the Precelerator called Flash Funders. So I think how we met, Len, back in those days, and was an early, executive there. The idea there was we were really trying to make early stage investing accessible towards more folks, really removing the barriers, removing the barriers and the clubbiness and just democratizing access to the early stage private markets. We were pretty successful, I think, for being sort of some of the pioneers in the field. You had AngelList at the time, WeFunder, some other folks obviously started engine here in Los Angeles. Flash Funder was actually acquired by an investment bank, and I'd say about, I don't know, a year into being at Flash Funders, I recognized that yes, I enjoyed meeting entrepreneurs. Yes, I enjoyed connecting with investors, but most importantly, or what I was most attracted to was actually doing the investing myself. And I was lucky enough to have a lot of support at Flash Funders as an organization, and also from both Aeroplay Capital, who's kind of morphed into Morpheus now, as well as Stubbs Alterden. And when I had basically expressed that I wanted to launch a fund, I had a lot of help, especially on the back office side, from the infrastructure side of getting that fund set up from Stubbs and from ECA. I went out and raised some capital and launched my first solo GP called Autochrome Ventures. I developed a thesis sort of similar to how I had my attraction to blockchain and the Bitcoin sector, which is just really identifying frontier technologies and industrial and enterprise end markets. So Autochrome was really focused on those frontier technologies and making sure that there was some sort of end market application, less science project and more practical in the use of the frontier tech. So constructed a portfolio, invested across space tech, immersive computing, applied AI, a little bit of synthetic bio. Definitely had an allocation towards some more impact focused investing as well, focused on underrepresented founders. So those are the areas that I invested in through Autochrome. Invested in about 30 companies. At the end of the deployment of that fund, I ended up meeting my now partner as Blueberry was getting off the ground. We met at Lacey, actually, so another Los Angeles connection, Los Angeles Clean Tech Incubator, when I was taking a look at some companies in the clean tech space. And I didn't jump over to Blueberry right away. I got recruited to a family office after Autochrome was deployed, and ran manager selection for them for about a year and a half on the venture and hedge fund side. So identifying emerging managers that were worthy of investing LP capital into, both mainly on the venture side, but I did do some public market managers as well. That provided, a totally different perspective for me, having been on the entrepreneurial side, on the venture side, and then on the LP side. You just sort of see that venture was really becoming more of an asset class than an index play, that there were a lot of players and that returns were going to be increasingly harder to come by. I knew that specialization was a way to sort of still capture that outperformance and alpha within the asset class. And I was really attracted to participating in the energy transition, just recognizing it's basically the largest capital campaign of our generation. So I started spending a lot more time with the Blueberry team. Initially, really just as a member of the investment committee, then more on a day-to-day basis, then finally joined the partnership. And at Blueberry we invest seed through Series B across data-driven technologies that are accelerating the energy transition, or optimize, enabling, and protecting existing energy assets. We are investing out of our second fund now, so that's kind of the journey for me.
And an incredible journey. It's not too often I get to sit with a person who is a partner in a VC firm who not only was an entrepreneur, but went into the funding side, looking at flash funders. And I remember that company well, and the differentiator there was, you're putting these funds into special purpose vehicles and really addressing cap table issues as it pertained to crowdfunding and getting that off the ground. And Vince and the team there was a great group of people to work with. And then you're working at a family office and working as an LP, and then finally back into the VC side. So you have a perspective that's unique, I think, in the venture capital community. Having played ball in each of those positions, mm-hmm. Which one is the toughest?
Yeah, I think undoubtedly being an entrepreneur is the hardest. You have your eggs are in one proverbial basket, right? Obviously, you'll have a chance if things don't work out to take another run and roll the dice again. But I think it's the amount of persistence and energy required to get up every day, and you're fighting a new battle every day as an entrepreneur. It doesn't stop. It doesn't end really ever. The thing about building companies is that, especially high growth companies, is that you're not waking up to the same company every day. It's always changing so drastically, either in a stage of growth or a stage of stagnation where there needs to be growth, or God forbid, one of contraction. So there's no doubt about where the most difficulty lies. I think that's not to say by any means that being an LP or being a VC is easy. I think they each present their own unique challenges. I think LPs have a very difficult job in that you are truly abstracted away from the product that you're investing in, and it's not advisable to really get too close. But both having experience on the allocation side, i.e. investing in managers, as well as, recently we just wrapped up our second fundraise. We kicked it off at the beginning of 2020. So it was an interesting year of fundraising. Luckily we were still successful, but, especially at the more institutional levels, there's a lot of moving parts to maintaining a portfolio. It's very competitive to get into certain venture managers, in the same sense that it's very competitive to get into certain deals as a VC. So it's all very, very complex and challenging for a variety of reasons. But the most respect for me always goes to the entrepreneur.
And since you've been there, and just looking at entrepreneurs that you've invested in over the years, whether that's at Autochrome or in the family office or in your current role, what do you think is the most significant attribute that entrepreneurs share, just looking at the ones that you've invested in? Is there something?
Yeah, I mean, I think it's honestly, it's very different. I even look for different things from different. I mean, really, age and experience. I have a pretty different lens around investing in folks then, and I mean, for better or for worse. It's definitely a result of my own experience, so it's entirely subjective. But I definitely am attracted to both, folks who maybe it's their second or third rodeo and they really are just compelled to be entrepreneurs time and time and again, and have learned a lot. And honestly, there's just there's a calm to some of those folks when things get a little dicey that you just can't have unless you've experienced it. And honestly, sometimes there's a slower growth curve across those entrepreneurs, but once they hit it, they really hit it, and the gas begins to burn. And then I really, the thing that I've enjoyed about investing in some of the younger folks. I mean, we've got some investments with a team that's, I mean, these guys have been at it for 4 or 5 years, and they're, I think the median age or the average age of the founding team is 26, 25 years old, and they've been at it for a while. So they've been, kind of first company has been on a successful trajectory. But the fearlessness there is something that I think I have a particular appreciation for, and the lack of being intimidated by incumbents, really, believing that you can, change things dramatically. I appreciate that added the youth, the younger side of the portfolio or portfolios. I mean, I think the underlying, what I see, and it's hard to say successful, right? Like I don't want to say that some folks that may not have actually had the multi-billion-dollar exit aren't successful. I'm sure they will at some point. So it's not always, you can define success in many ways in entrepreneurship, but there's a clarity of vision that I'm attracted to. I really just like to understand people who know exactly what they're trying to do and why. That doesn't mean they know exactly how it's going to happen, but they know why they want to do something, and have a very clear goal in mind. So clarity of vision is something that I've always been attracted to, and I mean, like, extraordinarily precise clarity of vision. You're on mute, I think.
I am on mute. Thank you. I owe you 50 cents. So I think that clarity of vision is really, really telling, and it goes to the ability of people to tell their story. What has been your experience in working with our storytellers here or anywhere that you work and invest in? What are the dynamics of that story that really, I guess, clarity of vision being one, is there anything else that you look for?
Yeah, I mean, I think that there are a lot of tropes that get trotted out, and I think there's value in some of them. It's try and personalize the problem that you're solving. Try and how are you the expert in this field? What's your unique perspective that other folks might not have? I think that there's, I guess something that I like is a small sense of humility along the way of the description of your journey. Maybe you recognize something that ended up not being correct, and that's how it's sort of influenced or affected the way that you're attacking the problem, or having that I guess period of reflection where there's something that is a true sort of learning experience that's informed your reasoning for starting this business. That's something that I've always been attracted to, is a little bit of humility and a little bit of reflection around exactly why you're doing it.
Great insights, great insights. Let's switch a little bit from the entrepreneur side of the business to the funding side and talk about Blue Bear. How big is your newest fund? How big of checks are you typically writing? Are you leading versus following on? Who do you like to syndicate with? Let's talk about some of those issues.
Yeah. So our first fund was about 30 million. This fund will be, our target was 100. We were lucky enough to oversubscribe that. We're at 120 million right now. We'll see. Our hard cap is 150. So we might hit the hard cap. We've got a few months left on the clock here for fundraising. But our check sizes are 2 to 5 million. We actually reserve 2x as opposed to 1x for follow-on. So we're kind of more concentrated than your average early stage VC. We invest seed through Series B, almost always lead, almost always take a board seed. But for every dollar that we're putting into a company, we're reserving 2. So if we put in 5, then we're going to have 15 in total that we're hoping to allocate over time. Gives us a little bit more patience, a little bit more flexibility on the back end. On the front end, obviously, when you're only investing in 12 to 15 companies out of a fund our size, it's highly selective, right? So even within the energy space, we probably looked at about 3,500 deals, and between funds 1 and 2, we've invested in 17. So pretty selective, and we try and batten down the hatches and be there even if things aren't going well, and understanding how things operate in the end markets of energy and industrials. You're selling, the sales cycles can be a lot longer than in consumer or even in enterprise software, across corporate. So we try to have patience and try to really provide connectivity. I forgot to mention, so a lot of our LPs come from, especially for Fund 1. Fund 2 now we're much more institutionalized as a fund, but in terms of our LP base, but our Fund 1 LPs and the core LP base for Fund 2 come from the energy private equity world. So we've got a lot of individuals and founders in some cases, MDs or partners in other cases, from Riverstone, First Reserve on the energy specialist side, and then Apollo, KKR, Blackstone, Ares, Warbird, et cetera, on the mega fund side. And that's sort of, how we try to square the circle there is a lot of the larger funds have, pretty significant asset holdings across wind, grid, solar, energy storage, and also have large workforces. So the digital solutions that we invest in, we can try to make that, knock on those doors and make that sort of the world of P that's a little bit opaque, a little bit more transparent. Hopefully deploy the software that we invest on the assets that are owned by some of the firms that our LPs work for.
Super. We've talked about the fund and the capital that you have. Let's talk about some of your portfolio companies. What's exciting out there right now? I know you guys just made an investment last month in Copper Labs. I don't know if you were involved in that deal, but what excites you about these companies and when you're looking at your total portfolio?
Yeah, I mean, Copper is an awesome company. They're out in Boulder. Really, they're signal processing wizards that have essentially created a plug-in device that allows for basically all utility meters in your house that have been traditionally serviced by drive-by data collection. So basically dumb meters turns all of that in. Basically, they're an instantaneous smart meter activation tool. So you plug in the device in the wall, and your water, your gas, and your electricity are all now being shot back to a database in real time, or basically 15-minute frequencies, so that you can essentially help with demand response, with basically shaving load during times of high prices, et cetera. So yeah, they raised some capital from us and from National Grid, which is a large British and US utility. along with others. But you know, what we're trying to do is identify points of, you know, we call it digital leverage, where you can essentially find technologies that are really, you know, on one hand enabling, you know, gigascale renewable development. A company like Shoreline, which is basically simulation and planning software for offshore wind. Company like Raptor Maps, where they're essentially identifying failure modes and increasing efficiency and capacity utility scale solar, so using computer vision. So this is essentially a company that takes aerial imagery, whether it's by plane, by drone, takes the imagery over a utility scale solar installation and identifies any problems that are decreasing its capacity output. But what we've done by enabling, you know, a software solution to basically predicting and solving and mitigating any sort of potential failure mode is, you know, on average they're juicing about, you know, 2 to 5% per utility scale solar installation. And at scale, if we're talking about gigawatts, we're talking about, you know, the generation that they're saving and increasing is, you know, equates to, you know, 3 or 4 coal-fired power plants for each installation at a certain gigawattage. So the way that we see the world is, you know, instead of putting more steel on the ground, and not to say that we don't need to do that, but instead of putting more steel on the ground and, you know, disrupting environmental capacities in that way, can we use software and digital solutions to really leverage and get the best performance out of existing assets? So that's one thing, and one theme that we're really interested in. On the local side, we were lucky enough to lead First Resonance's last round. First Resonance is a SpaceX spin out that has essentially created a digital connective tissue between design, engineering, and manufacturing in order to allow next gen manufacturing companies excuse me, the ability to iterate at the speed and scale of SpaceX. So, you know, their largest customers are two Los Angeles companies, again, Joby Aviation and Phase 4. So Phase 4 makes propulsion for small sats. Joby Aviation makes electric VTOLs, air flying cars in some parlances. And First Resonance is the manufacturing brain that allows for iteration and version control, essentially, for the manufacturing processes among those companies. And again, we see that as, you know, the digital layer that's enabling iteration and production of, you know, this next phase of mobility, or you know, remote sensing, or in some cases actual turbine manufacturing and solar component manufacturing itself, that, you know, that enables a scaled deployment of these next generation tools of mobility, or tools of remote sensing, or tools of generation that will, you know, sort of take us from, you know, the old ways of producing energy and of getting ourselves around to the new ways. So again, that digital leverage. In terms of other themes, we're really interested in learning more. We haven't made any investments in hydrogen space yet, green hydrogen. We have spent a lot of time around the financialization of carbon and carbon offsets, carbon credits, ESG credits, et cetera. And yeah, and then labor force transition is something that we've spent a lot of time around. So labor force transition / digitization. So a company like Datch, another LA-based company, which is, think of it as industrial Alexa. Another company is Mira, which is pretty relatively well-known company here in Los Angeles that is AR for frontline workers. So folks that are, you know, if you're up on a wind turbine, you can see a digital overlay of the repair that you need to carry out with someone, potentially seeing what you're seeing, hearing what you're hearing, and giving you instructions all hands-free, by virtue of taking a mobile phone and placing it into a headset and creating a visual field. So low cost, easy to deploy AR is something that we think is gonna be pretty impactful and pretty widespread on the front line over the next few years.
That's great. Those are exciting companies, Vaughn. And I love the fact that there are many right here in Los Angeles. I think sometimes the hard sciences get lost in the storytelling about the venture community here in LA. So let's talk about that. What does that VC and entrepreneurial scene feel like here in Los Angeles a year into COVID? Comparing it maybe to the past 5 years, do you personally see a difference in the number of deals that are coming in, or the types of deals, or how do you interpret what's going on in the Southern California ecosystem?
Yeah, I mean, I think we've just really seen, I think that there's always going to be, the local maxima, global maxima argument around, San Francisco being San Francisco and the Valley being the Valley. But, we've seen a lot of successes come out of LA over the last few years, and it's changed. The venture community down here has changed dramatically. There are many more funds, many more people have moved down here. I mean, you've got, some of the largest and most successful investors from Silicon Valley have moved down to Los Angeles over the last few years. You have these mega exits like Honey that really drive, I guess, one, our reputation, and two, just capital flowing through the ecosystem, right?
Right. Yeah. And Honey's a great example of where that carried interest stayed here, as opposed to a company like Snap, where the carried interest left here. And that's been the case for many of the exits that we've had in Los Angeles, because the big money, the BCD rounds, is not germinated here. It's coming from up north. So the fact that we are building companies that can make those BCD investments and keep that carried interest here is really important.
Absolutely, and I think you'll see more. I feel like every firm, all of the firms that were sort of fledgling when I first got into the tech community down here, have really gone on to raise successively larger funds, and in some cases growth vehicles, in some cases later stage vehicles. So I expect that to continue. I don't think we're anywhere close to the middle innings of Los Angeles's sort of place in the tech community going forward.
So it sounds like, from your perspective, you're very bullish on the direction that we're going within the Southern California region, in LA specifically. Having an anchor organization like the Los Angeles Clean Tech Incubator, how does that affect the sector that you're directly looking at?
Yeah, I mean, it's great. We get to see a lot of deals that I think we would otherwise have a more difficult time identifying, or at least getting to know very well, because so many come through Lacey in one form or another, whether it's through their actual accelerator program or through the events that they host. One of our portfolio companies recently raised a Series C that was announced via Riverstone. So, we definitely were able to make the connection and transfer from venture to private equity, a company called FreeWire, that was a Lacey portfolio company. So not only do we, enjoy a close relationship with the team, but, we've co-invested together, and we'll see how that one ends up. It looks like there's some exciting things happening with that company right around the bend here. But yeah, I think that it's crucial, and I hope that they're able to continue sort of expanding and growing and developing as they have over the last few years.
Super. Where are the holes? What do you see as some of our needs here in our region from a venture standpoint, or investment standpoint, or entrepreneurial standpoint? You can take it from any direction.
Yeah, I mean, I think we could use some more late stage capital, or, it would be interesting. I mean, this is, purely speculative, and perhaps some of my, I mean, it's not exactly on brand for them, but, you think of the Tigers and the Coatus that are extraordinarily active, these late stage, tech focused hedge funds that have traditionally been public and have increasingly waded into the private markets over the past 4 or 5 years. You'll see if we were able to have an LA, hedge fund that was as active and fast as those guys, I think we could probably pull pull some companies down here. Or I think there are a lot of people that do want to move down here that are, especially those that have been up in the Bay for a while, and you can get brainwashed if you're up there for too long. But having 2 or 3 large pools of capital down here, and it's not that we don't. I mean, we've got Ares down here, we've got Oak Tree down here, we've got some really large late stage capital. We just don't have large late stage, tech risk forward venture slash, sort of hedge funds that are crossover funds capital. So that would be fantastic. I think that's a whole. I think that just the nature of our city to a certain point does, you have these pockets of innovation that are operating everywhere, from Santa Monica to Pasadena, but rarely are we all getting together. I mean, COVID notwithstanding, but that's an issue. I think there are definitely positive elements about LA being so spread out, but there's a distance there that I think collaboration has difficulty overcoming from time to time. And yeah, I mean, I think that we definitely have it's changing. I think to your point, this history of aerospace, of the port, of energy here in Los Angeles is often overlooked, and we're always thought of as the media and tech capital. But there's so much more here, not only from a talent perspective with all the engineers that graduate from SC and UCLA and Caltech, but also just historical lineage of companies that have been built here. So that's just a struggle that you'll always have. We market ourselves as people think of us as beaches and movie stars, but there's just a lot more that's going on here.
Right, and just being fortunate to sit here in Santa Monica and enjoy that is something that I think we all take for granted, especially when I meet with investors that are coming here from New York in midwinter. They often wonder why aren't we headquartered here. What has COVID done, do you think, for the industry? I mean, we're looking at the first quarter results, Q1 2021, blowing it out of the water. Why is that?
Oh, I think it just accelerated everything, and it's VC is very much a play the game on the field type of sport, right? You can't. It's not public markets where you can put your hands in your pockets and it's not you're not a macro investor waiting for interest rates to change or guessing on whether interest rates are changing. We have funds to deploy, and if the game is moving fast, it's your responsibility basically as a fiduciary to try and play the game as it's being played. And all of the Zoom just really accelerated everything. You can get, just from it's pretty arithmetical. You can get more meetings in per day when you're not traveling. I used to fly up to the Bay once a week. If you think about that in terms of time, I was a lot of time that I was spending going to and from an airport and on an airplane or Ubering around San Francisco or Silicon Valley. So not having to do that, you just get more meetings in. You also chat with, I think that the serendipity or less investor to investor chat. And this is something that I've been thinking about, and I'm not sure if it's the case or not, but it might be interesting to folks here, especially those that are on the investor side. But the inverse of serendipity or happy hours and all of the interaction you have with other investors from a lot of firms is that a lot of the bearishness that pervades those conversations, like, oh, I met those guys, I don't like them, those conversations have been reduced like significantly. So that sentiment, the negative sentiment that you know, a lot of investors carry around with them, candidly, because everybody wants to think that they know better, and you know, generally being negative is perceived as being you know, you're more discerning than somebody who's optimistic. But that the lack of those conversations happening serendipitously, I think, accelerated a lot of deals getting done. So we'll see how that changes. You know,
that's a really
once
interesting insight. One that I think you only would know as an investor.
Yeah, yeah. So I think that we'll see how that you know, I think people are going to spend a lot. I think it's going to be a very recreation filled summer for a lot of investors. You know,
does that mean they're going to be harder to find and get in touch with, and to get in front of?
One thinks. I mean, if I was going to predict, that's what I would think, just because everybody's been cooped up forever. I mean, that's not how it's not how our firm's going to operate, but you know, I think that there's definitely got to be that fatigue, and at some level, people will be. I think it's going to be a hard summer to raise, and I've been, you know, trying to prepare our portfolio companies that, you know, either let's try and get something started now, or you know, you should try and push off to the fall, because I think it's going to be one of the harder summers to raise, as opposed to last summer where things went pretty quick.
That's a great insight, and great to pass that information on to the folks on the call. From a portfolio company standpoint, did you see any differences in 2020 through COVID as far as how they operated, or were there folks really worried, or did they use this as a time of acceleration?
Yeah, I think luckily for us, you know, we're sort of we've got two instances of secular change moving in our favor. One is just the energy transition, and two, automation. So in digitization. So that's where we focus, is, you know, AI, ML, and automation, really, in one way or another. All of our companies or evince some element of that triumvirate in terms of the way that their applications are felt. So, you know, Mira is a great example. I mean, the Mira as a remote expertise tool, as a tool for someone to be basically in two places at once. You can have a frontline worker go do an inspection while the actual inspector is, you know, at home looking through the camera via his laptop at home, and giving direction and going through a checklist. You know, those were deployments that happened across some very large, you know, I think I can mention Coke Industries, I think it's on their site, but other companies of that scale where they have Miras deployed now. They saved hundreds of thousands of dollars of plane tickets and extraordinary amounts of time by having those flown out, and then having someone basically at a mission control and going through the inspection process at home or at a, you know, some sort of HQ, and seeing and hearing what the frontline worker was seeing. That they're never going to go back. So it was an accelerant for companies like us, obviously, or companies that we invest in, but you know, obviously, you know, you had the travel sector. They ran into some problems.
Yeah, and I think from my standpoint, we're not going to lose this medium of meeting and working with people, whether it's on Zoom or Teams or WebEx or whatever medium you use. I think this has really shown people that you can meet people, and you can do deals, and you can monitor and help and coach and really make it effective, and save on the travel, and put more time into the home and to quality of life.
Yeah, I was trying to think. We have done, even during the heart of COVID, we would still try and do some kind of outdoor meeting with folks, you know, masked up, face to face, to get some sense of them, you know, personally. And you know, we did that for First Resonance. I think that was sort of an October deal timeline, if I recall correctly. But we have made an investment, or two investments out of Fund 2, where, you know, we never had a face-to-face meeting. So, and I think that's obviously happened a lot across VC.
Sure. Just switch gears before we open up to questions. This is always something that I think our industry has to look at, and that's the diversity and inclusion issue. Are there things that you as a firm are doing to make sure that you have a good pipeline of diverse founders? And how do you see the industry changing to accommodate, you know, these issues of serving underserved communities?
Yeah, I mean, for us, what we've really tried to be as proactive as possible about making sure that the funnel is filled with folks from all backgrounds. More so, I mean, the way that I see, you know, value both dripping down and projecting upwards from the diversity standpoint is, you know, our associates are, you know, we have a very diverse group of associates that we've had over the course of my time there. And that's something that I will intend to keep going, and, you know, bring these people up through the ranks, true apprenticeship, understand what VC is, and, you know, give these people the tools they need to either work with us in the future or find jobs at great firms. That's, I mean, you know, I don't know if I would be in the position I am if my father was an investment banker and private equity investor, so I grew up around this stuff, and I'm not sure if I would be in the same position if that wasn't the case. So I find it, you know, that's where I try and be as practical and personal in terms of the way that I can address that problem, and that's really through the lens of an investor. That said, obviously, I think, you know, we've got a long way to go around all this stuff. It's, you know, you see a lot of progress being made. I mean, you know, again, one thing, the last commitment that I made when I was at the family office was to Mac Venture Capital. So Marlon
Yep.
and Michael and Adrian and Charles's venture firm. So again, mainly I see attack things through the venture side, and hopefully there's, you know, you can get that leverage there. There'll be more than one in terms of investing in just a company. If you're investing in investors, that, you know, they'll invest in more diverse folks as opposed to just trying to invest in one person and say, okay, great, I've done my diversity investment, right? Like that's what I'm trying to avoid. But you know, I think that there are, to be entirely candid, there are very direct actions that can be taken, you know, at the largest technology companies in the world that are not taken, and that's, you know, you can talk about it a lot. You can release or not release your statistics, which a lot of these companies do, but it just takes really direct action and a commitment to change. There's no funnel issue as is often discussed. I think it's just putting people in charge that have that as a priority, and until that happens, we'll consistently be wishing that you know, things were better.
Great, thank you for addressing that. Any closing remarks before we open it up to some questions?
No, just, you know, if you guys come across any data-driven solutions across energy infrastructure and climate, send them my way.
Absolutely, absolutely. We'll put them in the hopper with the 3,500 other ones.
Exactly.
So let's talk about what's the best way to refer deal flow to you. If I'm an entrepreneur sitting on this call right now, and I think I might have a solution that works, what's the best way to approach you?
Yeah, I mean, I'm on Twitter. You can email me, Vaughn@bluebearcap.com. You know, I'm the one thing that I'm very much an open book, and will always take a look at things, even if they're not specifically in the niche, and see if I can be helpful. I mean, the only way you get anywhere is if you know, someone helps you and you help others. So
I agree with that, and that's a great philosophy to have. So good to know. Folks, let's open it up for questions, and you can unmute yourself and just ask a question, or you can use the little reactions button and put your hand up so I can know that you want to ask a question. But why don't we go ahead and see if we can get some questions asked? Anyone? This is a quiet
I'll
group
just
today. Yeah, go ahead.
I'll just go ahead. I'm Akinwande from Sermonis.ai. Sermonis is a program that is kind of like Siri for industry. So a lot of the things that you talked about is closely related to the stuff we work on. And we're actually a couple of founders. We all met at USC, so it's close by. But now we're actually in Berlin working on our startup because it felt like the European market was a little bit more receptive to early stage AI companies. And one thing that we were thinking about is and maybe you can give us your opinion on this, is what it might take to bring back home a company like us, right? Like how do you think we should go about talking to investors in LA or the Bay Area? How do you think we should talk about kind of maybe being binational or something like that? Because I think that's also how DAC is as well. They're like in the UK and a couple of other places.
DAC, yeah. Well, yeah, I mean, it's crazy. COVID was, we invested, they were up in SF, and then they were planning on moving down to LA, and then COVID happened, and the founders of Kiwi, so that their team was spread out globally for a while. Yeah, I mean, I think there are a couple of things I'll touch on. Hopefully they address what your question is. One, I think there's a tremendous amount of appetite for, to your point, just broadly software, AI-driven software in Europe. There's a lot of European VCs. We have a European venture partner. We have a European portfolio company. I think the idea of the entirely domestically restricted mandate is sort of falling away. So I think that there are a lot of both Europe-specific firms and crossover firms that will invest in North America and Europe that you should be able to have some good connectivity or conversations with. I think the issue, I mean, without entirely understanding everything about your business, but the idea that, or the question that I would have would be around just your go-to-market strategy and like who you're attacking. Are you attacking, just pulling something out of nowhere, like automotive OEMs? There are automotive OEMs in Europe and there are automotive OEMs in the States. Obviously there's like a cultural difference, especially like, you've got the German OEMs that operate a certain way, and then you've got, Ford and GM here that operate a certain way. How are you going about attacking, those two markets, and understanding if you were being stretched too thin and you really needed someone on the ground that was entirely focused in Europe and had those connections, or if you had some sort of special relationship with firms on both sides of the Atlantic that enabled you to pursue those opportunities concurrently. So being able to answer that question, I think, will put you in the right spot, and will also sort of restrict your universe of potential investment partners to either Europe-focused VCs or crossover folks. I mean, everybody, even upfront, Julian over in, I think he's in France, yeah, and he's running European investments for upfront. So there are more firms in the U.S. that are looking to Europe now than there ever have been.
Very interesting. Akinwande, thank you for joining us from Berlin.
Thanks.
Good to have you here. Do we have any other questions? Don't be shy, folks. This is your chance. Well, I'm not going to force the issue. I noticed that DeMarcus Williams from Silicon Valley Bank has joined us. DeMarcus, are you there? He might be just listening in. So I want to thank him for joining us. I want to thank Garrett Hill from Stubbs Alderton for joining us. I think you're the only attorney that we have on with us today. Anna, do you have any questions or any last remarks?
Yes, well, it's just kind of funny. I'm from New Zealand, so I'm really curious to look at that company that you told me about that's run by a Kiwi. But no, this was really insightful. So thank you so much for being here today and sharing with us your expertise and lay of the land. And just we're really lucky to have you. So thank you.
Thanks, Anna.
Awesome.
Anyone else? Last call. Well, folks, it's 1 o'clock, 1:01. I like ending on time. Vaughn, thank you so much for your time today. And everybody, I did not send any of these questions to Vaughn ahead of time. He just took them as they came. And that sometimes isn't as easy as he made it look. So thank you, Vaughn, for being insightful. Thank you for being your authentic self. I always appreciate that. Thank you for being a friend and a friend of our firm. And we look forward to seeing you in the future. And with that, folks, I'm going to end the call, and we look forward to seeing you all next month.